Have we reached maximum pain in financial markets? Is the sum of all fears finally out here, and are the markets, at the very least, already priced for the level of negativity that's out there? And is that going to be the first leg towards saying, we can deal with this, it's priced in, let's move on? Or are we still going to be shaken back and forth by this negative headline from that geopolitical event, or this one, or this issue with the U.S. Congress, or that one? Well, the price action certainly seems to point us in a direction, and the macro week ahead seems likely to support it. And that's what we're going to be focusing here today on Macro Money. Welcome. Cecilia Spivak, head of global macro here at tastylive. And that is exactly what our question du jour is going to be. Is maximum pain here? Now, as a preamble to kind of shape the lens for us, the key thing to keep in mind as we walk through what the various news flow on tap this week looks like and why it might push us one way or another, let's remember that markets are forward-looking. They are quintessentially driven by expectations. And what generates the movement of price in markets is the perpetual clashing of reality with those expectations. Those expectations are tested in real time against realized outcomes continuously and forever. And where realized outcomes don't match expectations, markets have to move because the assumptions built into asset values are shown to be wrong. And so those asset values have to go up or down depending on what occurs to reflect those differences. And whatever changes in expectations occur because reality turns out this way or that. Then, of course, the process repeats ad nauseum forever and ever. So it is with this in mind that we look at markets today and ask ourselves whether maximum pain has been reached. Because if it has, and that maximum is priced in, it need not necessarily keep moving markets lower, even if things don't improve. With that in mind, we take a look at the first bit of economic news that's going to be with us this week. We touched on it last week a little bit, and this is the October global PMI data set. And the important takeaway here is that it's probably not going to be very much better than September's. And this is what September's ultimately distilled into. What we're looking at here is taken globally, emerging markets, developed markets, and gives us a sort of view on what the global economy is doing in the manufacturing space, in the services space, and then taken together. These are, of course, the sort of pivotal areas of non-ag economic growth. Ag at this point is a pittance of a contributor to global economic growth. Services is by far the biggest, and manufacturing is after it for most developed economies. So when we look at this, what we find is the story has been generally negative since about the middle of 2021. Not surprisingly, this is where we get peak catch-up growth in the key demand markets of the world, the U.S., Western Europe. These are the buyers of the world's things, if you will. It's the end demand to which much of the rest of the world are vendors. And here, their catch-up growth in the aftermath of COVID seems to really peak. This is where you get the arrival of maximum fiscal stimulus impact. this is where growth sort of really hits its peak on the way back out of the pandemic lockdowns and really catches up in terms of speed. As ever, the PMI readings here have a center line at 50, where that's neither growth nor expansion. Above 50 and further above is an indication of speed. So too below 50 and lower. So if you go further above 50, that tells you you're growing at a faster rate. And indeed, in May, you can see here, May of 2021, you're looking at global PMI readings just under 60. So very, very quick pace of economic growth there. We then, of course, get the start of significant tightening being signaled by central banks. It doesn't actually begin until the beginning of the subsequent year, but bond yields already start moving at this point. So the credit conditions that the world is facing in anticipation of a tightening cycle, in anticipation of central banks fighting inflation, already starts to move. The recovery in global growth and the likelihood that further easing isn't coming, that already starts to lift bond yields by the middle of 2021 and starts to squeeze growth, and so it begins to decelerate. You get a kind of bump on the service sector at the start of this year. And some of that is spending on services that perhaps were being shunned before as a kind of last vestige of people keeping away from things that they were not allowed to do or didn't want to do during the pandemic. Things like travel, things like concerts and restaurants and sort of various public and outdoor and mass crowd activities. There's also, of course, the reopening in China that occurs at the end of last year and the release of that massive population out of lockdown and the service demand that comes with that. So you get a massive upswing in the global service sector at the start of the year. And by about the middle of this year, it fizzles. In large part because the stimulus leftovers that powered it and the China rebound or the China reopening that amplified it all collectively run out of steam by about the middle of the year. The service sector slumps back down, and as of September, we find ourselves with growth at a global level, the composite global index here, a hair above standstill. So the threat of global recession looking very acute here as the October numbers get ready to come out. Those October numbers, absent some sort of miraculous divine intervention, are probably not going to be very much better because, of course, the global economy doesn't turn that fast. And the situation has not meaningfully improved no matter where we look. So the likelihood is we again get a set of numbers that speaks to very touch and go global economic conditions, a lot of weakness and a lot of global recessionary tendency. Having said that, though, if we look at how economic data has performed relative to forecasts, it has increasingly improved going back to about July, August. It has improved globally. It has improved for developed markets first. It has improved for emerging markets thereafter. Not surprising there because emerging markets tend to be vendors to developed markets, and demand tends to live in developed markets, and the exporters and the economic engines dependent on that demand tend to exist in emerging markets. And so as you get things looking better for the buyers of things, the sellers of things see conditions improve with a bit of a lag. So we see here what appears to be a story about things not necessarily being better, but not worse than expected. And to the extent that this round of October PMIs tells us a story that says well, we're close to global recession. Things are anemic. Things are weak, but they're not weaker than we thought. In fact, maybe they're a little bit stronger. According to this, global economic data now tends to surprise higher on the whole relative to forecasts in seeing these surprise indices above zero. And so what that might encourage is a degree of bargain hunting. Folks might start to look and say, well, there are certainly all these issues still out here, but if the conditions that we're facing are less bad than we thought, then maybe those areas that have been the most beaten up this year, that have been the biggest sources of worry, need not be as big of a source. And so when we look at what has outperformed versus underperformed, we can clearly see markets in the U.S. have had a tremendous year relative to what's happening in Europe, relative to what's happening in emerging markets, relative to what's happening in broader EAFE, which is East Asia and Europe together. And so what we have here is then a situation where perhaps a bit of bargain hunting is more beneficial for those shares, for those things that have done poorly this year, as some of these sum of all fears concerns start to look less bad in aggregate than people thought they might. Which takes us to the next big important bit here and follows on directly from it. And what we'll do is we'll jump around a little bit in terms of the timeline, because what this immediately brings forward is the most troubled part of the developed economy world, and the reason why emerging markets as a group are still squeaking out positive growth, but developed markets are at this point as a grouping underwater. And that's at this point 3 months of contraction back to back in the Eurozone. By all accounts, the Eurozone economy as a region shrank in the third quarter, looking at these PMIs. Sub 50 readings here across services and manufacturing clearly, and the composite index now sub 50 for the third month in a row as of September. Seems unlikely that it's going to be surging north of 50 come October. So this is easily the most troubled spot of the key demand economies. It is also the spot where we've had the most spirited rebound in data outcomes relative to forecasts. Which brings us to the European Central Bank, which is due to have a monetary policy announcement this week. Now, the expectations are that we're not going to get a rate hike this time around. But where things get interesting is the actual policy path for the ECB implied in financial markets, actually priced into rates markets, has shifted meaningfully in a dovish direction since the ECB last met in September. And that ostensibly reflects both the idea that food inflation is the biggest component left in CPI, which has been falling quickly and is now sub 5% and quickly converging on 4%. Food inflation is not anything the ECB can really do anything about. It can't directly force food prices lower. And if you factored food prices out, then Eurozone CPI is more like 2.8%. So within a hair of something that feels very sustainably a path toward 2%, when we consider the economy is already in recession, almost certainly. At the very least, is shrinking for the past 3 months as a region. And that's after Germany's economy, the largest and biggest contributor to growth in the region, having already shrunk in the second quarter. So Germany probably gets confirmed as in recession come the third quarter, the Eurozone maybe a quarter later as a group. But conditions clearly are toward weaker economic activity, which of course is disinflationary. And so, taking all of this in sum, it seems the markets have concluded the ECB is not only not going to raise rates further here, as they expected as of September. We can see here the big dashed line here is the line corresponding with the last ECB policy announcement. And we can see here that gives us still scope for a little bit more tightening and then a hold. That's not what we're looking at here anymore. We can see standstill here at this 4% level basically for the next 6 months, and then rate cuts coming into the picture with about 50 basis points in easing between the middle of next year and the end. So we're looking increasingly at a situation where, on the one hand, it seems like things aren't quite so bad. Even as we have recession, the economic data is improving relative to forecasts. And on top of it, the ECB might well, looking at market expectations, come out and endorse the idea that rate hikes are over, that they're looking at inflation and, of course, are mindful of it, but that they now think they're on a sustainable path. All of which might be a boon for European shares and help them to capture some of the bargain hunting that we're talking about in broad terms happening across markets outside of the U.S. if the business cycle looks less bad than people expected, despite looking generally negative. Shifting gears, the other main pieces of the week reside not in Europe, but in North America. And the first of them is a monetary policy announcement from the Bank of Canada. It is expected to keep rates on hold, a mere 6.1% chance of a hike here, as we can see. And in fact, looking at the probabilities of policy changes all the way out to September of next year, we can see we never even cross the 40% mark, up or down. So we're looking at expectations for standstill, higher for longer, sort of epitomized here for Canada, looking out. No cuts, but no hikes from this point. And if we look at the way that the larger curve presents itself, we can see basically between now and a year from now, there's a slight chance for easing. So 4.8% is a mere 20 basis points off the current level. So one cut perhaps is something that's on the menu by the end of next year. So let's say the meeting in December of next year, which you can see this particular view doesn't capture. We don't have those quotes yet. But that's about it. In the meantime, there is standstill. Now, this matters a great deal beyond just looking at Canada. And we can see why very clearly in the latest set of Canadian GDP numbers. Here we can see domestic demand in Canada in the second quarter, which is the latest numbers that we have here, is actually positive. It's growing. Overall GDP, though, is down 0.2%, and it's because the drop-off in external demand, in exports, and the contribution from them is more significant and overpowers the rise in demand from the domestic side of things. Now, what is external demand in Canada? Well, shock of shocks, it's demand from the U.S. We can see here that between sort of the mid-1990s out to now, the share of Canadian exports that have gone to the U.S. have ranged between 85% and 65%. And since COVID, it's been going up. We're at about 78% now. So we're looking at a situation here where when we say that Canada's GDP is being pushed into negative territory because of weak external demand, what we're talking about is weak demand from the United States, overwhelmingly. And that is, of course, an important lens onto what might be happening in U.S. business conditions, and therefore an important indicator for the Fed. And of course, we've talked before at length about the idea that the Fed is essentially the indispensable central bank here, because since the U.S. dollar is by far the vehicle of choice to transact global commerce, 88% and change of global monetary transactions are ultimately settled in USD, according to the Bank of International Settlements' latest numbers. What the Fed does then when it raises rates is it raises the borrowing cost of that quintessential unit of exchange for everybody. And if everybody is transacting in it, then those Fed actions make the cost of borrowing more expensive, not just in the US, but everywhere. And so with that in mind, if we get a sense from Canada that conditions are weak, that it sees every reason to hold rates here and not to keep hiking, despite inflation still being relatively elevated, because its main export market is not looking like it is going to support a robust growth environment, well, then that tells us something about that biggest export market and tells us that the business cycle there is looking anemic and probably keeps the Fed from being higher for too much longer. At the very least, it doesn't portend a situation where the markets might conclude that easing for the U.S. central bank, that would give the entire global economy relief by lowering global borrowing costs, is going to be delayed any further than it's already been delayed, and any further than the Fed already is signaling it's going to delay it. And so the more worried the Bank of Canada sounds here, the likelier it seems the markets will conclude that a less worrisome Fed follows, all of which perhaps helps with that bargain hunting that we've been talking about. Into that same category of catalysts goes the Fed favorite measure of inflation, the PCE index, the personal consumption expenditure version. This is different than the consumer price index, different methodology, different timelines for reference, different ways of managing revisions of past data. But the general thrust of the trend here, very much the same as CPI in the sense that goods inflation has been almost fully squeezed out. It's services inflation that remains. This is what the Fed is looking to target. It can't really have much of an impact on the biggest contributors here, which mainly is housing, and which is so sticky in price, mainly because the Fed's own actions have yanked up mortgage rates to a point where liquidity in the housing market has effectively vanished. Nobody's a seller because nobody wants to refi at these levels. And so we've entered into a space here where what the Fed must then focus on is the labor part of the service sector equation. On this score, it looks like we're going to get continued progression, much as we did with the CPI numbers. They were a little bit higher than expected, which of course created consternation in the markets, but the reason they were should be very telling here. And for reference, we'll have a look here. These are the main contributors to September's CPI numbers now. This is not PCE, that's not out yet, of course. This is CPI, but the story should broadly hold. The biggest contributor was energy. And on the whole, energy was still a net negative. So what's really happened here is The main reason why CPI was a little bit higher than the markets anticipated wasn't for any Fed relevant reasons. That core year-on-year reading came down. And all of the things that the Fed is trying to impact, namely services, excluding food and energy, that disinflated also. It's energy having been less of a negative factor that really gave us the uptick in CPI that we saw. If that is going to carry through here into the PCE numbers, as well one might expect, the upshot is, well, this is not anything that's going to get the Fed to reconsider restarting rate hikes or hold rates elevated any longer than they already think is appropriate, at least by itself. And so again, we get a set of numbers here that perhaps tells us a story that isn't good so much as it's not worse than what is expected. And in this environment, that might well be enough for markets to encourage looking at opportunities to find some bargains. And we can define sort of not worse thus. So we can see here the likelihood for a rate hike from the Fed is actually just 1.6% for the November meeting. In fact, we were looking at a cumulative probability for a hike much closer to something like 40 or 50% even a couple of weeks ago. But of course, in the wake of Chair Powell's speech last week, where he made such a clear argument for we probably have a bunch more tightening in the pipeline and rising bond yields are doing our job for us, that we now have just 23% chance of a further rate hike before the end of the year, just 38% of chance of a rate hike by January. So the markets overwhelmingly think that the rate hike cycle has ended. The easing begins no later than July. The full cut is baked in for that meeting with a 31% chance here for a second. That's right here. So at least one cut by July. And whether we get that cut in June or in July seems to be close to a 50-50 shot. There's a slight chance we could get it in May even, although the probability there is still relatively low. But it looks like, give or take, we're tilting to no later than July. A second cut is almost fully baked in September and fully arrives by November. And we're a hair away from a third in December, which then is fully baked in by January of the subsequent year. So this essentially emerges as the baseline. As long as the numbers don't get rate hikes pushed any further back in the timeline as a consequence of this week's data, we should perhaps be expecting markets to be in this bargain hunting mode. And that is the week ahead. We'll, of course, look at all of these things in more granular detail as they come out throughout the week. Macro Money is here Monday through Thursday every week right after Overtime, a show that I co-host with Chris Vecchio, head of Futures and Forex here at tastylive, and Dylan Radigan, where we try to figure out what happened on Wall Street on a given day and what may follow. I'm on with Chris again for Futures Power Hour on Fridays, on with Tom and Tony for First Call on Sundays, writing for the News and Insights section of tastylive.com, and opining sporadically on the platform formerly known as Twitter at eur-usd. Thanks very much for joining. Macro Money will be back tomorrow. In the meantime, happy trading out there. Take care.